Yep.
I was watching Jerome Powell today, sitting on a chair, just telling people it's not QE. Like they
Oh,
meant,
right.
like said it like four times. Like
Yeah. Yeah.
it's like what? Well, what are you going to call it? Because whatever it
Right.
is, it's you're exploding the balance sheet on this pace. You're doubling it in about 2 years. So
Right. And that's exactly what they said in 2008, when they blew the thing up was this is not going to be inflationary because we're going to quarantine that. Do you remember
right,
Ben Bernanke stating
yeah.
that at the time?
Yeah, we could always draw this down and then QT drew it
Right.
down by like what 700 billion, but nothing.
700 billion, and then the system's on the verge of collapsing, and actually what we said 10 years ago, not really going to happen.
Yeah, it's like. I'm traveling late this week, and thus this Metals and Markets wrap is being completed prematurely to the close of the week's precious metals trading action. As of Wednesday evening, both silver and gold are trading slightly higher than the close of late last week. Simply look at the top of either sdbullion.com or silverdoctors.com to find closing fiat Federal Reserve note spot prices for the three major precious metals. As for the Federal Reserve, Don't Call It QE Chairman Jerome Powell stated on Tuesday that he and his colleagues at the U.S. Central Bank will soon announce measures to add to the supply of reserves over time. Powell went on to confirm, as we indicated in our March statement on balance sheet normalization, at some point we will begin increasing our securities holdings to maintain an appropriate level of reserves. That time is now upon us. So the Federal Reserve balance sheet expansion is now an ongoing policy, along with likely further interest rate cuts to come. This week, we welcome returning guest Christopher Aaron of iGoldAdvisor.com back to our Gold and Silver podcast. In our discussion today, we throw out the technical analysis to the side and talk about the larger pictures at play for silver and gold related asset classes. We get that conversation underway right after this brief message from our show's sponsor. SD Bullion is a high-volume, physical precious metals dealer here in the USA. If you are acquiring an investment-grade bullion position, be sure to bookmark www.sdbullion.com/deals, where each and every week we source some of the best bullion deals for our over 100,000 customers worldwide. Stay tuned to sdbullion.com, the lowest price, period. Welcome to this week's Metals and Markets podcast. I'm your host, James Anderson of SDBullion.com. This interview is being recorded at 3 p.m. Eastern on Tuesday, October 8, 2019. We're welcoming back our returning guest, Christopher Aaron of iGoldAdvisor.com. Christopher, thanks for coming back on the podcast.
Thank you very much, James, for having me.
So, Christopher, the last time we had you on was late June 2019. The gold spot price then was around $1,410 per ounce, and now we're up almost $100 an ounce. Silver price back then $15.35. We're up about $2.50 an ounce. The gold silver ratios dropped a little bit. We're down below 85 level. I think when we spoke last it was 92. So some positive steps in both precious metals. I wanted to begin, I guess, with just your feelings about, and also give the preface that we're not going to go through a lot of charts technically this week. So people out there who don't believe in technical analysis, you don't need to leave. We're just going to be talking about the general topics of the precious metal market and the financial markets in general. I want to get your thoughts, Chris, to start off. What's the state of the gold and silver markets that you're seeing right now in later 2019?
Yeah, so exactly right. We're not going to be dwelling on the charts too long. Of course, I can never fully get that, the view of when I study the charts out of my mind. So there are a few points that I think it's really important for precious metals investors to be thinking about right now. So in the last 3 months, as you mentioned, James, since we've talked, we see this rise in gold to above 1,500. And what we're talking about here is that resistance. When we last spoke, we were talking about the resistance near 1,434 per ounce. It was that level dating back to 2013. So we were talking about a 6-year resistance level. And in the last couple of months, gold has broken above that and is now coming back some. It's stronger today, but coming back some from the recent highs above 1550. And when I think about a market like that, when you think about a market that had been grinding and moving sideways and frustrating a lot of people for 6 years, and then finally exceeds a key level like that, that's a very healthy looking market. I was cautionary at the time, and we'll get into this a little bit later. There still are several cautionary statements that I want to make here, some things that I'm observing in this market that have me a little bit concerned, not for the immediate moment, but likely for some time in 2020 of perhaps a more significant correction in the precious metals. But just bringing it back to the present, when we see a market that's broken out of a 6-year consolidation, let's call it between 1050 and the low 1400s, and we've finally broken out of that, that looks good. And when we're talking about a short-term basis here, we're in this correction off the recent highs, 1555 or so. I suspect that this correction has a little bit further to go, another several weeks, perhaps a month or so. And I actually think from the health of this market, from a health standpoint, as far as what are the most healthy trajectories for a market to take, if we look at, for example, the type of move that Bitcoin did in 2017, where a market just starts moving vertically, and month after month is just moving straight higher. We can see the result of that. That tends to be a very unsustainable type of advance. So in gold here, considering that we've had that breakout above the low 1400s, and now we're backing off some, this is actually the most healthy market action that I could possibly ask for. Mm-hmm. So I'm pleased to see this right now. I hope that gold comes back right now to the low to mid 1400s. Mm-hmm. I think that would be a real excellent setup, because basically we would have that breakout from a 6-year consolidation. And then we're coming back to retest it, and then we take off for the next leg higher after that. Mm-hmm. That is what I'm thinking for gold. And then when we get that price action, especially if we start to exceed the recent highs, the next target that I'm going to be looking for gold is $1,711 per ounce, to be precise. And 1711 is calculated based on an amplitude measurement of the entire surge that we saw in 2016, that surge off the low in 2016, added on to the breakout point of the base, that 6-year base that we were talking about in the low 1400s. So we have a calculation there. And so that's what I'm setting my sights on for this market over the next 6 to 12 months after the present correction that we're in finishes.
Mm-hmm. Yeah, I was looking at just some micro data the other day. It was, I think, the Perth Mint, in terms of their gold coin sales, been well exceeding the amount of new gold eagles that have been sold at the U.S. Mint. And I'm sure you look a lot in your research about what's the gold price doing in other currencies, and obviously Australian dollar gold price is at new record nominal highs, and a lot of other currencies such as Canadian dollar or the euro or the British pound, all hitting new nominal price highs. So I'm not as technically sound as you in terms of my numbers, etc. But it just feels like, yeah, the dollar's been strong, but at some point there's going to be some intervention, I presume, in the dollar's strength versus other currencies around the world. And when that intervention occurs, we're probably going past the old 1900 nominal price high and into new uncharted territory, I imagine, for gold.
Yeah, that's a really good point, gold and foreign currencies, because what's happened over the last year, there is still a strong inverse correlation between the US dollar and gold. However, for the last year, we've actually been in one of those periods where both the dollar and gold are higher simultaneously. Mm-hmm. And so it's kind of flipped that on its head, to some extent. But yeah, the gold performance in foreign currencies is encouraging to me, at least from the aspect of thinking in a highest probability that gold in US dollars is not done yet. This move is not over yet. when we see gold and Australian dollars, I mean, surging above that previous high from 2011, gold and euros challenging the all-time high, gold and British pounds challenging the all-time high, Canadian dollars reaching a new all-time high before backing off some. And then the big one, this is one that we don't pay attention to that much here in the Western markets, but gold and Japanese yen having a major surge. And the reason that's important is because we had seen gold and the Japanese yen being treated functionally equivalent by the market since 2011. Basically, anytime there was a quote unquote flight to safety, based on, let's say, trade wars or based on threats with North Korea, remember that going back to 2017, we would see gold and the Japanese yen higher basically together simultaneously or lower together simultaneously. And we could argue till we're blue in the face that shouldn't be happening from a fundamental standpoint. And I would agree with you, but it was what was happening. That's what the market, some of the participants were doing from 2011 to 2019, except just in the last 3 months, we have seen the Japanese yen moving flat and we've seen gold surging. So something in that relationship, with gold and foreign currencies has really been changing. And it's encouraging to see. And, I think this move as gold and US dollars is not done yet for that reason. That's part of it.
Sure. And the silver price, how are you looking in terms of the silver price for, maybe the remainder of the year into the next? Are you feeling like that we're going to be able to make a run toward the 2021 area?
Silver is doing what it does the best, which is to frustrate people and frustrate attempts to chart it out, especially from a short-term trading basis. So I've moved away with that with silver. That said, there are things we can still observe. Even when a market frustrates you, that doesn't mean to totally turn your back away from it. There are things that we can learn. And the big thing that I would say for silver is, let's just think about it. We have gold well above its 2016 high now, if we were using those as important data points, well above its 2016 high, which was 1378. So we're almost $150 above that. And we still have silver below that 2016 high. And if you ask me, this right now, the correction that we're seeing in silver is the most, after this correction is over, this is the most legitimate chance silver has ever had to see a significant catch-up move, especially when we're talking about any point over the last 6 or 7 years. This is the most legitimate moment that it has, especially from a technical basis. But also fundamentally, something else that I'm looking at is we're seeing what looks to be like a long-term bottoming pattern setting up in the CRB commodity index. So over, and we're talking about an average of 19 different hard assets, which includes gold and silver, but it also includes oil and natural gas and platinum, palladium, and some agricultural commodities. The theme here is we're talking about things that the Federal Reserve can't print out of thin air. And I'm looking at the CRB right now, and it's just kind of bumping along recent lows. It's certainly no one's really talking about it, but it actually looks very healthy, like it's putting in or attempting to put in a real long-term bottom. So I think if the CRB, if the average of all commodities is going to stabilize here shortly, then I think it at least creates something of a backstop on the silver market. So the question is, are we right now, this exact moment in a bull market in silver, right? So we can debate about that. But there's a difference between having questions about whether or not we're in a bull market right now and separately being able to say, hey, when we look at some of these other things, especially the sum of commodities getting ready to bottom, I can tell you that the downside risk in silver is quite limited.
Mm-hmm.
And so whether or not that emerges into a bull market right now, or whether that needs to be still, a little
Mm-hmm.
bit ahead of us, those are separate questions.
Yeah, that question I posed it last week with our listeners was it was just a general question of the guest we had on last week. We talked about the last time we had him on, and the last time we had him on was 1280 gold and like 14 silver, somewhere in the $14 an ounce spot range. And I posed the question: are we ever going to see those prices again? And you can never say never, but when you talk about fiat currency, I mean, obviously the reserve currency has a little bit different of a way that it's treated, but maybe say we have some crazy black swan and everyone rushes to the dollar, like Jim Rogers is, he's betting on that, thinking he holds a lot of dollars, saying that the world essentially, the fundamentals for the U.S. dollar are terrible, but the world just that doesn't know any better, and when there's a crisis, they run to the dollar. That's just simply what they do, and so. I guess it's a question of, are we going to have one more U.S. dollar bang higher in terms of its purchasing power versus other currencies, and have a push down in the spot price, or are we just going to have the Federal Reserve come out and say it's not QE, but our balance sheet keeps growing at $184 billion a month, and we're going to keep
Yeah.
growing it in perpetuity, and so everyone in the market's going to know, well, that's QE, and so the last time they were doing QE1 and QE2, it was explosive for gold and silver prices. And
Yep.
QE3, I think you touched on it. There was something going on with the yuan, with the Japanese yen, and some type of carry trade. I think that's really helped suppress commodity prices. I think, and so looking out, ultimately, that's always when I look out further. I just think, well, they're going to have to devalue the dollar versus real things in order to pay off a lot of these promises they've not funded, and so. When I look out, it's just a question of timing, I guess, and being positioned for it and being ready for when that time comes.
Yeah. These are a lot of really good points, a lot of things for us that we could talk about here. I mean, the Federal Reserve at this point, it's almost laughable what they're doing here with the balance sheet expansion for stress in the repo market. And one thing that I've said over and over is that the Federal Reserve really only has one tool. It's all about how much money are they printing? And then the only second question we can ask is, where are they going to give that money? Who are they going to give it to?
Right.
And so, okay, which banks are in trouble and which mechanism are they in trouble by? And so we see the Fed printing money to assist the repo market here recently, 100 and something billion, as you mentioned. And it's just, I mean, I know we have a lot of new people here who have become interested in the precious metals only in the last few years, and some longtime listeners I know as well. But for those who are newer to the market and maybe who are not following this market in the crash of 2008, we had outright promises at that time by the head of the Federal Reserve, Ben Bernanke. I mean, outright promises on live television that the QE programs were not going to be permanent. They were not going to be permanent additions to the balance sheet. And of course, when they say additions to the balance sheet, that is a euphemism for printing money. Again, back to that. And he came right out and said that. He said, no, we're going to extinguish this. We're going to remove it from the market later on. It won't be inflationary. And what did they do? They got some $600 or $700 billion into reversing that program in 2017 and 2018. The market began to fall apart. The stock market, that is, the banks were in trouble again, and they balked. So there's that promise from 2008 just being thrown out the window. But it's like, who remembers the promise now 10 years later? So here we see them doing the same thing again. And, it certainly is. The one thing, though, that I think where I wonder, and of course, Jim Rogers has a whole lot more experience in the markets than I do. But I wonder, so the last crisis in 2008, we saw that flight to the dollar. We saw the dollar rising in the crisis and everything else selling off, including gold, silver, stocks, commodities, everything. From my study of market history, subsequent crashes or subsequent, events tend to not follow the exact same playbook as the most recent one.
Mhm.
And so I almost think it's a little bit too easy. I think a lot of people have been saying, well, people are going to run to the dollar the next time. I think that's a little bit too easy. I think
Mhm.
that's like just looking at the most recent crisis and saying that therefore things are going to happen exactly like that again.
Right.
I don't think that's going to happen. I think there's going to be a new twist the next time. Um, and one way or another, I don't think the flight to safety is going to be in the U.S. dollar.
Yeah, that's an interesting point. If we do have a situation where the U.S. dollar is not bid in a crisis, that'll be one of the first times. Obviously, I think anytime you go back and look at recessions, major ones globally, usually people do run to the dollar. But if that is the case, something new will be going on. And my hunch is it'll probably be some coordination where the U.S. Treasury knows that they will help out the rest of their partners in the world by devaluing the dollar a little bit. In 2017, we devalued the dollar by 10% in one year, and then had a little bit of strength since then. But the valuations happened in the 70s. We had overnight devaluations in the early 70s
Yep.
by 10%, and it was on the regular evening news. It was just kind of the norm for the early 70s after Nixon cut the final ties to Bretton Woods with the dollar and gold.
Exactly right.
So I mean, this is common, and so in the future, looking out to think that there's not going to be dollar devaluations again, I think is kind of it's absolutely crazy to not think that the precedent's already been established. We've already done this before. The only question is, in what twist will we get it?
So I want to just mention for a moment, because we've talked about how the next crisis is probably not going to be like the last one, and so then it's like, well, how could we not be in a bull market right now for precious metals? What are some of my reservations? I just want to say that.
Mm-hmm.
And when I say that I have reservations, I'm not saying it from an all or nothing standpoint. I own precious metals. I continue to accumulate them with a portion of my holdings. I'm also heavily involved in the gold and silver mining world. Um, and so I say these things, and when I have cautionary statements, it's never this yes or no. We're in a complicated world here with many different cross currents happening at the same time. Um, and so when I look at, there's a few things that are still giving me this pause for caution, such as, for example, why has the gold to silver ratio refused to materially compress thus far? And we've seen it kind of flirting with 20, 25-year highs, making that new high above 90. It's like, where are the silver buyers? And obviously I'm not talking to your listeners because they are buying, but we're talking about where are the big silver buyers. So that's one of these cautionary statements. And the other thing is, when I'm looking at the performance of the gold mining complex versus gold itself, it's really been lagging. I mean, significantly lagging. And I've gone back in history and I've studied, I've studied every period in the freely traded era from 1971 through the present. This relationship between the price of gold and the gold miners. There has never been a period where, when the gold miners are lagging so much like this, that it ends up being a bull market right now.
Mm-hmm.
It can be a prelude to a bull market, a lead up, one of the initial sort of shock waves.
Mm-hmm.
But it's always been a cautionary thing when we observe these kinds of things. And so it makes me wonder if the precious metals markets, after we hit some higher targets, let's say within the next 6 to 18 months, which I do believe are in store, it makes me wonder if, when we get to that point, are we not going to see something like a more significant correction, you know,
Mm-hmm.
from some of those levels?
Mm-hmm.
And then I have to ask the question, well, what could possibly, what could account for that? What from a fundamental standpoint could actually cause there to be, something of a significant, and let's say at least multi-year correction, right,
Mm-hmm.
from some higher levels? What could cause that? Um, and I wonder if we're not setting up for a period here in the stock market that's not like 2007, 2008, but more like the early to mid 1990s. So we have to drop back two entire cycles. And we have to look at that and think, well, in the early 90s, I mean, was there in mid 90s, was there inflation? Of course. Was the Fed expanding its balance sheet and printing money? Of course. Were there troubles in the banking system? Of course. Long-term capital management, major hedge fund blew up. They had to come in and slash interest rates down to 1%. A lot of things going on in the world at that point. The Asian crisis in Japan in the 90s. But we look at a period like that, and amidst all the inflation that still was in the system, what ended up happening is that the inflation was funneled into the stock market, actually. And in the 90s, precious metals kind of drifted sideways / lower, for those years as the inflation found a perverse outlet, if you will, in bidding up the NASDAQ bubble. And I would say when I'm thinking about a scenario that could be unfolding here, I think that would be my negative. And it's not an outright negative. We wouldn't be talking about some sort of a collapse in the precious metals like in 2008, but it would be more perhaps the bull market is a bit further off than necessarily right this second, to last for the next 10 years. And perhaps, when I'm looking at, for example, the U.S. stock market, it's definitely been struggling recently to make anything like new highs. It's been a real gyration kind of market, and it's overvalued if you ask me from a fundamental standpoint. But it's rare for markets that have been moving higher like that for 10 years to just kind of peter out in a sort of a fade type of move. Typically, you will see something that develops like that, and then it has to really exhaust itself into like a mania. We're talking like a bubble. And so I wonder if there's a bubble in the stock market, does that suck some liquidity out of the precious metals markets into the final high in stocks? And then when the stock market finally peaks, that's when the metals become the premier asset class in the world.
Yeah, it reminds me of George Soros's quote that he said, I forget, it was like in the early 2010s, I think, maybe 10, 11, 12, somewhere in there, where he said, he called gold the ultimate bubble, and everybody thought he meant at that moment that it was a bubble. But I think what he was saying is essentially that when all this expansionism is done, all said and done, and we can't expand much further, it'll be gold that accounts for it, essentially. It's the last asset class that bubbles out as we move into probably a winter phase in this financial system, and possibly into a new spring toward the later part of our lives. But
Yeah.
it's
It's the only asset class
but
that they can revalue against and not disturb the entire flow of commerce around the world.
right.
If they were going to devalue the dollar versus the housing market, let's say, and housing prices across the country were going to double overnight, you'd have a shutdown in the mortgage industry. But gold, they can devalue the dollar versus gold, and the system can keep going. You just have a higher gold price.
Right, right. I mean, I think the last time that we did that, obviously, was 1934, and I think Jim Rickers has argued. I'm sure others have argued that price, $35 an ounce, was too low, and that was the reason why it was too low. Is you saw it right after World War II. It was too low, and everyone else knew it, and they kept pulling gold out of our holdings and into theirs. France did it all the way into the early 70s, and others did it too, and that broke up the Bretton Woods system. And it had us, as the United States, we bled out about 12,000 tons of gold from the end of World War II, and we had about 20,000 tons post-confiscation to what we claim to have now, which is roughly 8,000 tons. So it was obviously arbitrarily too low, and by setting the price too low back then, it kind of made the Great Depression continue on further. And that was, I think, the argument Jim Rickard said, is that it should have been much higher. It should have been probably twice that price, $70 an ounce.
Sure, exactly. Yep.
Yeah.
And that's
So
what price controls do universally. I mean, when anyone sets a price of something artificially low, it always causes shortages in the market. You look back to the 1970s when they tried to set the price of gasoline low, and you had lines at gas stations, and you had rationing.
yeah.
In the inflationary period there. So same thing. The rationing in the gold market and the shortages simply happened because France and other countries, as you said, were demanding their gold back, and so the gold was not staying in Fort Knox; it was moving overseas.
Yeah. I wanted to get your thoughts on a story that's going to happen next week. And maybe we haven't even discussed it, I don't think, yet on this channel. But the CME Group's COMEX, which and most listeners probably know that gold futures contracts are traded on the COMEX, and they're probably the most important derivative out there that kind of sets the spot price for gold. And that spot price for gold is used to set the price of bullion most of the times. And so it's very important how the COMEX futures market is trading in terms of gold and silver prices too. This coming week, next week, October 14th, I believe CME Group's announced that they're going to be issuing a new COMEX yuan-denominated gold futures contract. Not just one, but two. One that's going to be denominated in fiat Federal Reserve notes, but also another that's going to be denominated in fiat yuan renminbi. I found the story kind of interesting in the sense that we're in the middle of a trade war, and here we are inviting the Chinese to come over with their yuan renminbi currency, and basically allowing them to come into our critical price discovery markets, and affirming that they're okay in the midst of a trade war to come in here and start moving prices around if they so see it. I found it super interesting, and I think it's one of these things where there's something beneath the surface, I think, going on between U.S.-China relations that most people in the gold silver market probably don't understand. And I think that it's probably in both interests from the United States and China long term to control the melt up in price of gold and to help devalue some of the promises in the fiat currency issuance that's gone on in both countries. I mean, am I speaking in crazy talk here, Chris? Does that make sense?
No, something is very interesting happening here. Yeah, exactly like you said, with the continuation of these trade wars with the U.S. and China. And, most recently, President Trump, for example, just in the last 2 weeks, talking about issuing an executive order to delist multinational Chinese companies from U.S. stock exchanges. This was the big thing, and talking about removing some of the ADRs, which are ways that foreign companies can trade on the New York Stock Exchange. Talking about that, he was talking about clamping down on pension funds around the U.S. from being able to invest in any index funds that are investing in any Chinese companies, which I will tell you what are the majority of the pension funds in the United States. Because if you're owning a broad U.S. stock market index, you're absolutely owning some of these ADRs for Chinese firms. So here we see this on one hand, the escalation of the trade wars. It's like, get China out of our markets, and then suddenly, hey, let's open a new gold contract priced in yuan.
Right.
Something interesting and slightly fishy is happening there.
Yeah, the CME Group, for people that don't understand, it's the entity that runs the COMEX and NYMEX, and the CME Group is, they're literally like one step away from the U.S. Treasury. I mean, when they have big meetings about financial markets, CME Group head is right there. I mean, they basically are dictating the price of real things in the real world, okay? And for anyone who thinks that the empire wouldn't want to control prices, I think is walking around in a childlike way. I just don't understand why you would, if you're looking at financial markets, would you not think that the empire would want to have some dictation over what prices are going to do? So it's on record since 2014. CME Group's been inviting foreign central banks to come in and have discounts for trading various commodities such as gold, silver, platinum, palladium, or derivatives of interest rate denominated contracts, things that have to do with FX, even Bitcoin. I mean, I've done the article on it. You can look it up. Just simply search manipulation continuation CME Group, and you'll find it. It's documented fact. I'm not the first guy that found it. It was I believe the guys over at GATA who found it, but it just sounds so fishy. The idea of, hey, foreign central banks for the last 5 years, come on in and trade our markets. And then,
Yeah.
hey, PBOC, you guys gonna want some trading discounts too? Come on in. I mean, it just, to me, the whole thing just reeks of coordination that we don't really know what really is the ultimate agenda here.
Yeah, yeah, it's a very interesting development. Um, and there's one other thing happening right now that I want listeners to really key in on here, where again, this is something that we do not have the final answer to because it's happening as we speak, related to the Federal Reserve, is actually this battle that's happening between President Trump and the Fed. And we've seen this both through the escalation of the trade wars with China, where Jerome Powell has come on to basically call out President Trump and say that, hey, if the executive cabinet or the executive branch here in the United States is issuing trade wars, we at the Federal Reserve cannot be responsible for what happens to the economy in that case. And then we've had these retaliations by President Trump against Powell that basically have no precedent here in the United States. I would say, with the exception of going all the way back to Andrew Jackson in the early 1800s and the dissolving of the Second National Bank of the United States, which was the last central bank that we had here in the 1830s before the Federal Reserve, almost 80 years later. That's the last time that we've seen rhetoric so strong out of the president directed against the central bank in the country. And I mean, this used to be a huge no-no, in U.S. politics. This used to be like a major no-no. Presidents were basically told from somewhere to keep their lips shut about the central bank. We know that President Trump is a bit of a renegade. But I think actually the most ironic thing, which is happening, is that he's not criticizing the Federal Reserve for example, printing too much money or, bailing out member institutions or whatnot. He's criticizing them for the inverse.
Right.
He's saying the Fed should print more money and should be lowering interest rates to negative, as if that type of action would have no consequence.
Yeah.
So, I just think this is a fascinating time to be alive, to be an observer of these markets and of current events, because I just have to say, the history books on this are not written. And I think wouldn't it be something if the dissolving of the third central bank in U.S. history is actually sparked by a president who wants it to print more money, not less, and that leads to its downfall eventually. I think that would just be a hilarious twist in the history books.
Yeah, that would be. But the it would definitely be darkly humorous. But the experience of going through a really bad inflation scenario, that would not be fun. It's like it's something that no one cheers for, but obviously protects against by holding a core position in bullion. But that's certainly not what anyone wants to see. But it's scary in the sense that that's, I think, what we're flirting with a little bit with some of the things that are going on that are unprecedented in financial history, really.
Absolutely right.
So, Chris, I wanted to give the listeners out there the chance to perhaps see you if they're going to be in the San Francisco area. You're going to be speaking at the Silver Gold Summit by Cambridge House in San Francisco. I think the event is on October 27th and 28th, the end of this month. Our listeners out there, we have a 50% off code you can enter in if you're going to go to the event to get 50% off of the fee. It's just simply put Aaron50 into the promotional code, Aaron50, all one word, 50. Don't write out for the word 50. So it's just AARON 50. That would be it. And you'll save 50%. And you're going to be speaking at that, Chris? Is that correct?
Yeah, that's right. I'm going to be speaking. So that's and they haven't actually given me the date yet. It's either going to be the first or second. It's a 2-day conference. Mm-hmm. So it'll either be the 27th or the 28th. You can check the website as soon as they post the schedule. But I'll be there the entire weekend, both days. And yes, as you said, there's going to be a lot of good speakers there, a lot of interesting minds talking about various aspects of the gold and silver sector. So if anyone wants to come, make sure you use that coupon code. It'll save you 50%. As you said, AARON50. But yeah, it would be great to meet any of the listeners too. I'm only speaking on one day, and so the other day I'll just be going around to some of the booths and speaking with people. So it'd be great to meet anyone who wants to come out.
Well, cool, Chris. I hope that that they record the speech that you give, because that would be very nice for those that can't make it to potentially get to see what you had to say at that event. But we'll wait and see if they do that for you or not. But as to close it out, I just wanted to let our listeners know how they can find you, Chris. Where can they get your thoughts on an ongoing basis?
Thanks a lot, James. The main website is the letter I and then goldadvisor.com. That's iGoldadvisor.com. And we publish premium research on gold, silver, and the mining sector, as well as the exact gold miners that we are investing in here. And I also work with individuals, just to let you know, and there are reputable dealerships out there, such as yourself over at SD Bullion, and I know you guys personally. And then there are some not so reputable dealerships out there. And so what I do with individuals is to work with investors from the standpoint of an individual investor, someone who's not affiliated with any of the gold mining companies or any of the dealerships, but I work with individuals who want an independent evaluation of their situation. And if there's one thing I could say, it's that I think the present environment requires a sufficient core holding in bullion. When we see this kind of rhetoric ratcheting up between President Trump and the Federal Reserve, you've got to have a sufficient core holding. And then for certain individuals, there is something to be said about adding some targeted leverage to that, but in a way that works for them. And so that's what I do across the spectrum, is just try to make sure that individuals are properly positioned according to their own risk and reward tolerance here.
Christopher Aaron, thank you so much for coming back on our podcast.
Thanks a lot, James. Best to everyone listening.